What's happening, friends? Welcome back to Dynamo DeFi. My name is Patrick, and on this channel I talk about cryptocurrency, decentralized finance, and economics. Earlier today, a bipartisan bill was submitted to the United States Senate that would create a regulatory framework for cryptocurrency, referred to in the bill as digital assets. In today's video, I'll go through some of the highlights of the bill, as well as what the implications could be for the world of cryptocurrency. Let's get into it. First, before getting into all the details of the bill, let's look at a quick overview of what I saw as the 5 most important points, because there's a lot in the bill and I won't be able to get into all of it in this video. But the 5 things that jumped out to me as the most significant is that first, the bill establishes cryptos as either regulated by the Commodity Futures Trading Commission or by the Securities Exchange Commission, also known as the SEC. And it also clarifies a new type of asset known as ancillary assets that would be regulated by the SEC but wouldn't be considered securities. More in a bit on what would be considered an ancillary asset. Second, it creates a framework for taxing crypto. And to me, this is one of the best parts of the bill because it would either answer or set us on a path to answering a lot of questions that people have, like how you tax staking rewards and how you should consider airdrops when doing taxes. And of course, this would apply for now only to people in the United States. Third thing it does is it regulates stablecoins, and this is likely to be one of the more controversial parts of the bill. I think people have been expecting this coming for a while, and the UST collapse may have accelerated it, but basically the bill requires that payment stablecoins be fully collateralized and sets up a framework for banks and credit unions to issue their own stablecoins. Fourth thing that it does is it regulates digital asset exchanges. So it sets up reporting requirements as well as other types of regulatory requirements for exchanges and clarifies that they would be regulated as commodity exchanges, basically. Fifth, it creates the right to individual management of digital assets. And I think this is incredible. Basically, it codifies into law that you have the right to self-custody your crypto if you're in the United States. More on that in a bit. So that's the high-level overview of what's in the bill. Let's go through a bit more detail about each of those points. So the first one I mentioned is the clarification of commodities versus securities. So the bill specifically calls out Bitcoin and Ethereum as 2 examples of commodities. And the bill says that most crypto assets, or digital assets as they're referred to in the bill, would be appropriately considered commodities. The exception being assets that, and I think this is probably already the precedent, but it hasn't really been fully enforced in the world of crypto, is assets that benefit from the entrepreneurial and management efforts, but that do represent a claim on debt or equity or the right to profits or revenues of a project. And so that would basically divide projects into something like Bitcoin, that would be a commodity, and potentially some sorts of individual protocols that would be considered securities. But what it also does, and this is really interesting, is it creates a category known as ancillary assets. And these would be regulated by the SEC, but would have diminished reporting requirements. And these are basically assets that benefit from the entrepreneurial or managerial efforts that determine the value of the asset, but they're not a claim on any rights to profit, revenue, debt, and so on from the protocol. So I think this is probably a mixed bag, this first point, as far as the world of crypto goes. Great that Ethereum and Bitcoin are considered commodities. That's a majority of the cryptocurrency market cap. I think we're well past this point, but people don't need to worry about the industry being regulated out of existence. And it's also good that they are clarifying that there are things that could be issued either as a utility token or some other sort of token within a protocol that wouldn't be considered a security. But on the flip side, this does set up reporting requirements for those sorts of tokens, and it does set us on a path towards potentially having some sorts of governance tokens or other sorts of tokens classified as securities. And with that would come significant reporting requirements. So even if something isn't an unregistered security, if it's an ancillary asset, they would still be required to file with SEC twice a year. And this would have a lot of implications for anonymous projects. Now, this is going to be potentially difficult to enforce since anyone can deploy a smart contract. It doesn't really even need an owner. It could be outside the United States, could be done anonymously. And so I think that this is easier said than done. But I imagine that if this goes through, this will put a damper on the amount of anonymous projects that are being created, and it may make it more difficult for anonymous projects to get listed on exchanges. More about some other regulations that will happen on exchanges in a bit. But overall, though, I would say that given how this could have gone, this part of the bill, I think this is relatively friendly to cryptocurrency. I wasn't expecting them to create a new asset class that's defined as digital assets, which have no reporting requirements at all. But I'll be watching to see how they enforce this sort of securities requirements in the future. Second thing it does, and like I said before, I think this is probably the best part of the bill, is it creates a framework for taxing crypto. So basically, it does a few important things related to taxing crypto. The first is that it creates something called the de minimis exclusion. So it specifically calls out that cryptocurrencies are intended, or some of them at least, are intended to be a form of payment. And that's not realistic that you would report every single payment that you made as a taxable capital gains sale, right? If you hold Bitcoin, then you use it to buy something. Technically, you are cashing out. Basically, this says that if you're spending under $200 per transaction under specified conditions, that it would be excluded from taxes. And that is really great. It gives people a way to spend some of their crypto potentially without having to pay capital gains tax on it. Another thing that it does that's really important is it clarifies how mining and staking activities are classified. So imagine right now, if you were a Bitcoin miner and you earn 1 Bitcoin and say it was worth $60,000 at the time, and then you don't sell it, you hold it. Are you taxed on the value of that Bitcoin at the time that you mine it when it's $60,000? Or if it drops to $30,000 and then you sell, are you taxed at the time of sale? And this clarifies that you would be taxed at the time of sale. So if you're staking and you're compounding, then you don't need to worry about it until you actually sell those assets that you received from staking. So that would be, I think, both a major positive for the industry and also some much needed clarification. Additionally, although it doesn't clarify how airdrops would be counted themselves, it does require the IRS to issue guidance on how airdrops and other sorts of lingering questions in the crypto industry would be handled. So that's really good because, I mean, I think we probably know what's going to happen as far as how airdrops will be considered, but there's been a lot of uncertainty in the United States over how people should report those on their taxes. And at the very minimum, we need to have clarification, right? So to me, that is a major positive, and it tells me that the people who wrote this bill did have some guidance from people in the industry, because that's a pretty specific requirement, if you ask me. Third thing it does is it regulates stablecoins, and this is going to cause some major stirs in the industry, although I think it'll cause fewer stirs than it would have prior to the UST collapse. Basically, it requires that all payment stablecoins can be cashed out for assets that are 100% of their face value. And it requires stringent reporting requirements for people who are issuing stablecoins to prove that they have assets backing those stablecoins. Does this mean that there won't be decentralized stablecoins in the future? No, it does not, because there's the entire rest of the world besides the United States. And it's also possible to create digital assets anonymously. However, I would say this probably would make it more difficult for something like UST to gain the traction that it did in the future. Because if they do have these requirements, then exchanges that service United States customers or that otherwise do business in the US would probably be more hesitant to hold stablecoins that didn't meet regulatory requirements. Another thing to consider is that it's possible someone could create some sort of asset that was able to hold its value, but that wasn't actually pegged to the United States dollar. And that might be another way that people could get around this. But I think people were kind of expecting something like this for a while. After what happened with UST especially, can you really blame them for creating some sort of requirement like that. I mean, people lost their life saving, and generally I'm skeptical of regulations, but you can understand why this would be one of the focal points if they were, focused on, quote, consumer protection. One positive side of this is that it does create a framework for banks and credit unions to issue their own stablecoins. And would I prefer to use a stablecoin that was crypto native versus one that was issued by a bank? Yes, I'd prefer the crypto native one, but this would lead potentially a lot more money flowing into crypto. And honestly, if a lot of different banks are creating their stablecoins, then protocols that allow them to provide liquidity between them and allow them to swap could benefit significantly, looking at U-curve. So I'll be interested to watch how this develops. But yeah, basically, this is a lot of the stablecoin regulation that a lot of us were expecting. Sort of quick aside, one other thing that it does, which was not one of the major points that I called out before, but it creates a definition in law for decentralized autonomous organizations, but interestingly requires them to be incorporated or organized under law. So, again, very difficult to enforce what qualifies as a DAO at all. That would need to be registered, but we'll see how this is actually enforced, because I think that they'd find that it was more difficult than they expect. Another thing to consider is that a lot of these reporting requirements for a big enough protocol, there are ways around it, right? They could have some sort of entity that is registered and have the main players still be operating behind the scenes. But that's a whole different situation. The fourth thing that it does, the fourth major thing, is that it regulates digital asset exchanges. And I think this is probably the portion of the bill that has the most potential to affect DeFi right away. And basically what that does is it sets up a lot of requirements as far as reporting, as far as consumer protection, and so on for digital asset exchanges. And I think the reason why this could be significant is that we'll have to get clarification on this eventually, but as it's currently created, it does seem that this could apply to a lot of, quote, decentralized exchanges. So something like Uniswap might be required to operate under these requirements as well, where it registers as a digital asset exchange. Maybe they are required to do some sort of KYC. And yeah, I think that is going to really change the world of DeFi. Again, can't enforce that across the entire world, and anyone can deploy a smart contract. But I think that would potentially solidify players that are willing to abide by regulations as the major players in the space. Because although decentralization is great, let's be honest, most people in the world are going to use the legal regulated option. That's just how people are. And so requiring that of digital asset exchanges could have major implications and could make it very difficult for people to spin up these small DEXs in the future. I forget exactly what section of the bill that was in, so I apologize that I can't pull it up right away. And another thing that's interesting to note in terms of the regulations of digital asset exchanges is that, and this is a positive, is that the bill explicitly clarifies that miners and validators would not be considered brokers, because that was a major concern with past regulation, is that if they were talking about people who process transactions having to do KYC or having to file various forms of paperwork, then they would say, well, validators are technically processing transactions, but it specifically calls out validators and miners as people who are not brokers and would not have to fill out that regulation. So that is good. That is very good. Fifth and final thing that I want to call out from this bill is there's been a lot of talk, especially in countries besides the United States, about having some sort of requirement that people who hold digital assets, or crypto, as we like to say on this channel, people who hold crypto would have to have some sort of custodian to hold it. And I think there is a place for custodians, because a lot of people are irresponsible with their key security. But basically, there's been talk of having requirements that either a custodian or exchange would have to hold the assets, and you couldn't hold them yourself. This would codify into law, this bill would codify into law in the United States, the right to individual management of digital assets. And so this is awesome. I see the fingerprints of people from the crypto industry who were advising the senators all over this. And basically it says that, except as otherwise required, no person shall be required to use an intermediary for the safekeeping of digital assets legally owned and possessed or controlled by that person. So this is great. This means that you will be able to self-custody the fundamental principles of crypto, of owning your own assets, controlling your own financial future, would continue to be intact despite any other regulatory changes that were created. And overall, those are what I see as the most important things in the bill. There's a lot of other random stuff in here about commissioning various reports, creating committees to investigate things. There's a lot of things that have to do with looking into CBDCs, looking into the environmental impact of the cryptocurrency industry, and looking into cybersecurity. So if you're interested, you can check out the whole bill. But to me, those 5 things I just mentioned are the most significant as far as the implications for the industry. Now that I've said that, what's missing? Because to me, there were a few things I was expecting to see some clarification on in this bill that I did not. And so the first thing is no mention of NFTs. So it remains to be seen exactly how those would be classified. It seems to me they do mention at one point fungible assets in regards to securities. So that seems to imply that perhaps NFTs would not fall into that category. But there's no mention of non-fungible or NFTs in the bill, as far as I can tell. So I would have liked to see some clarification over how those are regulated. Are those considered commodities, or are they just considered something entirely different? Another thing that would have been interesting to see is clarification on whether proof of stake assets are securities or commodities. Because although they mention Ethereum and Bitcoin, Ethereum is still proof of work at this point. So would a proof of stake asset where you're receiving network fees for holding the token, would that be considered a security? And I suppose that we'll find out in time, but I was really expecting some sort of clarification on that within this bill. And related to that, I would have expected some sort of requirement for the SEC and CFTC to sort out these sorts of questions sooner than later, right? So after this bill, we're still wondering, would Ethereum on proof of stake, or would, say, another proof of stake coin like Cardano or Avalanche, be considered a security? It would be nice to have some sort of clear answer on that, at least for major assets, sooner rather than later. And the final thing that I was expecting to see, or was hoping to see, was some clarifications on decentralized exchanges and how those would have to register, or whether those would fit into the category of digital asset exchanges. Again, it seems likely, but it would have been helpful to have some sort of call out for how those sorts of things would be provisioned. Overall, though, I think this legislation could have been much worse. I think it does both a lot of positive, a lot of negative for the industry. Regardless, having regulation would long run lead to more money entering, because there's a lot of money right now. And I talk to people all the time who work at financial institutions who say that, yeah, they'd love to invest in crypto, but until there's regulation, they just can't because for compliance reasons. And so I think that overall this would be a positive for the industry, but would potentially make it difficult for certain DeFi projects to operate within the United States. And the final major change that it would make, of course, would be that it would make it much more difficult to launch projects anonymously, because it would have additional reporting requirements, which to me means that if this were to pass, probably we would see a bifurcation where you have projects that are fully doxed teams, fully regulatory compliant, and then you have other projects that are anonymous and go through great pains to obscure their identity, either by using mixers like Tornado Cash or by using privacy networks. In fact, I could see this sort of thing leading to a boom in privacy networks or those sorts of mixers, because you could launch a coin or a token without having to reveal your identity much more easily on a privacy network with smart contracts. And that's what you need to know about this new crypto bill. Let me know what you think about it down in the comments. Are there any other parts of the bill that jumped out to you as particularly significant to the industry? If you enjoyed this video, please like and subscribe. And until next time, this is Dynamo DeFi.